Hey everyone, welcome back. So are you ready to dive into the world of dividend stocks and see how they can help you build some serious passive income in 2025?
Absolutely. It's a topic I'm really passionate about.
Well, I know a lot of our listeners are really interested in this too. Who wouldn't love to make money while they sleep, right?
Exactly. That's the beauty of passive income.
So we dug into this comprehensive guide on dividend stocks, and I've got to say, I learned a ton. There's so much to unpack here.
Yeah, there really is. It's a fascinating area of investing.
I mean, we're talking about everything from these intriguing dividend aristocrats to a simple formula that can help you estimate your potential earnings.
And don't forget about those risk management strategies. Those are crucial.
Right. Got to make sure we're protecting our investments. Okay, so let's start with the basics. Why are dividend stocks such a solid choice for passive income?
Well, the beauty of dividend stocks is that they provide a reliable stream of income. You're not just relying on a stock's price going up, which can be unpredictable. You're actually getting consistent payouts from the company.
It's like getting paid just for owning a piece of the company.
Exactly. And those payouts can really add up over time, especially when you factor in the power of compounding.
I'm definitely intrigued. But sometimes when I hear reliable and stable, I think about those giant, slow-moving companies that have been around forever.
Well, there are certainly some well-established blue chip companies in the dividend world, like Johnson& and Johnson or Coca-Cola, names everyone recognizes.
Yeah, those are the classics.
Exactly. But it's not just about size, it's about a company's commitment to sharing profits with shareholders and having the financial strength to do so consistently. That's what makes them reliable.
Okay, that makes sense. It's not just about getting a piece of the pie. It's about making sure the pie keeps growing.
Exactly. And speaking of growth, this guide mentioned something called the compounding effect.
Yeah, I was hoping we could dig into that a little bit. To be honest, sometimes my eyes glaze over when people start talking about compounding.
I hear you. It can sound a bit technical, but it's really a powerful concept once you grasp it.
So break it down for me. Make it real.
Okay, so imagine you invest $1,000 in a stock that pays a 4% dividend. You could just pocket that $40 each year, but with a dividend reinvestment plan, or DRP, that $40 automatically buys you more shares of that same stock.
Okay, so now I have more shares earning dividends. I see where this is going.
Exactly. It's like a snowball effect. And those new shares will earn dividends too, which you can reinvest to buy even more shares. Over time, the growth can be incredible.
That snowball analogy really paints a vivid picture. I'm starting to get it now.
It's a game changer for long-term investors.
Speaking of game changers, this guide also mentioned that while the average dividend yield of the S&P 500 is around 1.5%, there are some stocks out there with much higher yields.
Oh, absolutely. There's a wide range of yields available, depending on the company and the industry.
So should we be chasing those high yields, or is that a recipe for disaster?
Well, like with most things in investing, there's a trade-off. Higher yields can sometimes come with higher risk. Maybe the company is in a cyclical industry or they're facing some internal challenges. That's where research comes in.
So we need to understand why a company is offering such a high yield and if it's sustainable over the long term.
Exactly. Due diligence is key.
Okay, makes sense. Now, you mentioned dividend aristocrats earlier. They sound pretty exclusive. What makes them so special?
These are companies that have increased their dividend payments annually for at least 25 consecutive years.
Wow, 25 years. That's impressive.
It really is. It shows incredible financial strength and a real commitment to shareholders.
So companies like, I don't know, Clorox, I feel like they've been around forever. Are they a dividend aristocrat?
You know, Clorox is actually a great example. They've increased their dividend for over 40 consecutive years, which makes them a dividend king.
Dividend king. There's even a level above dividend aristocrat.
There is. It's a testament to their consistent performance and their ability to navigate changing market conditions while still rewarding their shareholders.
Okay, you've convinced me. These dividend aristocrats are the real deal. But now I'm thinking, how do I actually find these gems and start building my own dividend portfolio? Where do I even begin?
Well, the first step is to set a clear goal. Figure out how much passive income you want to generate each month or year.
Okay, so we need a target to aim for.
Exactly. This helps you focus your strategy and choose investments that align with your income goals.
All right, set a goal. Got it. But then how do we pick the right stocks? I'm comfortable doing research, but are there any specific tools or resources that you recommend?
There are some great tools out there like Yahoo Finance and Morningstar that provide in-depth data on dividend yields, payout ratios, and the financial health of companies.
Okay, so we use those tools to do our due diligence. But I remember learning a long time ago that you shouldn't put all your eggs in one basket. How does that apply to dividend investing?
Diversification is absolutely crucial, just like with any investment strategy. You don't want to put all your money in one company or even one industry. Spread your investments across different sectors to reduce risk.
So if one sector takes a hit, the others can help cushion the blow. Makes sense.
Exactly. It's all about managing risk and building a balanced portfolio.
But for someone just starting out, all this can be a little intimidating. Are there ways to dip our toes into dividend investing without having to pick individual stocks right away?
Absolutely. Dividend ETFs are a great option for beginners. ETFs, or exchange-traded funds, hold a basket of dividend-paying stocks, giving you instant diversification.
So you get exposure to a range of companies with just one investment.
Exactly. One popular example is the Vanguard High Dividend Yield ETF. The ticker symbol is VYM. It's a great way to get started.
That sounds like a great starting point for a lot of people. And once you get comfortable with ETFs, you can start branching out and exploring individual stocks, right?
Exactly. Start with an ETF, gain some experience, and then gradually add individual stocks as you build your knowledge and confidence.
Okay, I'm liking this step-by-step approach. So we've set our goals, done our research, diversified our portfolio. Hopefully those dividends are starting to roll in. What's next? What else should we be thinking about?
Well, we touched on it briefly earlier, but the real magic starts to happen when you reinvest those dividends. Remember those DRIPs we talked about?
Yeah, those dividend reinvestment plans. I get that reinvesting can really accelerate growth over time, but I'm more of a visual learner. Can you give me an example of how powerful this compounding effect can be?
Absolutely. Remember that $1,000 investment with a 4% dividend yield we talked about earlier? If you just hold on to those dividends each year, after 20 years, you'd earn around $800 in dividend income.
It's not bad.
Not bad at all. But here's where things get exciting. If you reinvest those dividends over those same 20 years, your investment would grow to over $2,000.
Oh, well, wait a minute. So we've more than doubled our initial investment just by reinvesting those dividends.
Exactly. That's the magic of compounding in action.
I'm starting to see why people get so excited about dividend investing. But, as much as I love the idea of my money working for me, I also know that there's no such thing as a risk-free investment. What are some of the potential downsides or risks we need to be aware of with dividend investing?
That's a great question, and it's important to be realistic. While dividend-paying companies tend to be more stable, it's important to remember that dividend payouts aren't guaranteed.
Oh, okay. So even those dividend kings and aristocrats, we can't just assume those dividends will keep flowing in forever.
Exactly. Companies can reduce or even cut their dividends during tough economic times, or if they need to reinvest profits back into growing the business.
So even with those blue chip companies, we need to do our research and make sure they're in good financial health.
Absolutely. Monitoring their performance is key.
And what about those market ups and downs we always hear about? How do those impact a dividend portfolio?
Market volatility is a natural part of investing, and dividend stocks aren't immune to it. Stock prices go up and down, and sometimes those swings can be pretty dramatic.
So how do we deal with that roller coaster ride?
It's important to remember that dividend investing is a long-term strategy. Don't panic and sell off your stocks when the market dips. Instead, focus on the fundamentals of the companies you've invested in and maintain a long-term perspective.
So we ride out those waves and focus on the horizon, right? But what about inflation? Can that chip away at our dividend income?
That's a great question and something a lot of people don't consider. High inflation can erode the purchasing power of your dividend income. What you could buy with $100 in dividends last year might cost you more this year.
Okay, so how do we combat that? How do we make sure those dividends are keeping pace with rising prices?
One strategy is to maintain a balance in your portfolio between high-yield stocks and those that are more growth-oriented.
So high-yield stocks provide a larger income stream now. But growth-oriented stocks have the potential to increase their dividends more significantly in the future, which can help you outpace inflation.
Exactly. It's all about finding that sweet spot between current income and future growth potential.
It's like a delicate balancing act.
It is. And the right balance for you will depend on your individual goals, risk tolerance, and time horizon.
This is a lot to digest. I'm feeling a bit overwhelmed, to be honest. There's so much to think about when it comes to building a dividend portfolio.
It can seem daunting at first, but remember, we're breaking down complex concepts into manageable pieces. We're just getting started.
Okay, that makes me feel a bit better. So where do we go from here? What else do we need to know about dividend investing?
Well, we've covered a lot of the foundational concepts, but now we need to start digging into the details. Let's explore some specific metrics and strategies that can help you evaluate those dividend-paying companies and build a portfolio that's aligned with your goals.
Okay, I'm ready to dive deeper. Let's get into the nitty-gritty.
One thing that often gets overlooked is the importance of the payout ratio.
Payout ratio. Okay, that's a new one for me.
It's a simple calculation, really, but it can tell you a lot about the sustainability of a company's dividend.
All right, I'm all ears. Break it down for me. What is this magical payout ratio, and why should we care?
It's the percentage of a company's earnings that it pays out as dividends.
Okay, so if a company earns $1 per share and pays out $0.50 in dividends, its payout ratio is 50%. Got it.
Exactly. So basically, it tells you how much of its profit a company is sharing with shareholders and how much it's keeping to reinvest in the business.
So a lower payout ratio means they have more room to grow, like more cash on hand to invest in research and development or make acquisitions.
Exactly. A lower payout ratio can be a sign that a company is prioritizing growth and may be able to increase its dividend more significantly in the future. But a high payout ratio isn't always a bad thing either.
Wait, really? I thought we were saying lower is better.
It depends. A high payout ratio can sometimes indicate a mature company that's generating strong cash flow and returning a larger portion of its profits to shareholders. Think of it like a well-established tree that's producing a lot of fruit each year. It doesn't need to focus as much on growing taller, it can just keep providing a steady harvest.
Okay, so it's not just about the number itself. It's about understanding the story behind that number. So we look at the payout ratio, we do our research on the company, we check out their financial health. Anything else we should be paying attention to?
You're thinking like a pro. Another important factor to consider is the dividend growth rate. This tells you how much a company has been increasing its dividend over time.
Wait, hold on. Isn't that what those dividend aristocrats are all about? Increasing their dividends year after year?
You're right. Those dividend aristocrats are the masters of consistent dividend growth. But even within that elite group, there's a range of growth rates. Some companies might be increasing their dividend by 2-3% each year, while others are growing those dividends at a much faster pace, maybe 8-10% or even more.
Okay, so a higher dividend growth rate is generally a good sign. It means the company is doing well and sharing that success with shareholders. But is there ever a time when a really high growth rate might be a red flag? Like maybe they're growing too fast and it's not sustainable.
That's a sharp observation. You're right. Sometimes an extremely high dividend growth rate can be a sign that a company is trying to attract investors or prop up its stock price in the short term. It's important to look at the big picture. How is the company's overall business performing? Are they growing revenue and earnings at a rate that supports those dividend increases?
So if the dividend growth seems out of sync with the company's fundamentals, that's a signal to dig a little deeper and do some more research.
Exactly. You want to make sure the growth is sustainable.
Okay, so we've talked about payout ratio, dividend growth rate. I feel like we're really getting into the weeds here. How do these metrics play out in real life? Can you give me an example?
Sure, let's look at two hypothetical companies, Company A and Company B. Let's say both companies currently pay an annual dividend of $1 per share. On the surface, they look similar, right?
Yeah, pretty much.
But when we dig a little deeper, we see some key differences. Company A has a payout ratio of 80%, meaning it's paying out most of its earnings as dividends. Its dividend growth rate over the past 5 years has been a steady 3%.
Solid, but not spectacular.
Right. Now, Company B has a payout ratio of 50%, leaving it more room to reinvest for future growth. Its dividend growth rate over the past 5 years has averaged 7%, more than double that of Company A.
Wow, okay. So even though both companies are paying the same dividend right now, Company B seems like it has a brighter future.
You got it. Company B is demonstrating a stronger commitment to growing its dividend over time, and that's something that dividend investors really value. Of course, this is a simplified example. There are always other factors to consider, but it shows how understanding these metrics can help you compare companies and make more informed decisions.
I like it. It's like having a secret decoder ring to unlock the mysteries of the stock market.
Exactly. It's all about using the right tools and information to make smart choices.
This is great stuff, but I have to admit, sometimes the financial world feels like it's speaking a different language. Are there any simple rules of thumb we can keep in mind when we're evaluating dividend stocks?
Well, there's no magic formula, but here's a framework you can use. Look for companies with a history of consistent dividend payments, a payout ratio below 75%, a track record of dividend growth, and strong financial health. These are usually good indicators that a company is committed to rewarding its shareholders and is well positioned for future growth.
Okay, I can remember that. History, payout ratio, growth, and financial health. Check. But even with all this information, there are still risks involved, right? We talked about dividend cuts and market volatility earlier. What else should we be thinking about?
You're right, risk management is crucial. One thing that often surprises people is the impact that interest rates can have on dividend stocks.
Oh, interesting. I never really thought about that.
Yeah, when interest rates rise, it can make bonds and other fixed income investments more attractive to investors, which can sometimes lead to a shift away from dividend stocks.
So if I can get a higher return with less risk from a bond, why would I take on the extra risk of the stock market? Makes sense.
Exactly. So it's important to be aware of how interest rates are moving and how they might influence investor sentiment towards dividend stocks. But keep in mind, this is just one piece of the puzzle. There are always multiple factors at play in the market.
Okay, so how do we factor this whole interest rate thing into our overall strategy? Do we need to become experts on monetary policy now?
You don't need a PhD in economics, but it's helpful to have a general understanding of how interest rates affect different asset classes. And remember, diversification is your friend. Don't put all your eggs in the dividend basket. Consider having a mix of investments, including bonds, real estate, and even some alternative assets to help balance out your portfolio and manage risk.
So we diversify across different types of dividend stocks, and then we diversify even further by adding other asset classes to the mix. It's like building a financial fortress. But even with a fortress, sometimes things can go wrong, right? What about those unexpected events that can shake up the market?
You're talking about what we call black swan events, those unpredictable events that nobody sees coming, but that can have a major impact on the global economy. Things like pandemics, wars, natural disasters, you name it.
Right. Like who could have predicted that pandemic back in 2020? That threw everyone for a loop.
Absolutely. Those are prime examples of black swan events. They're impossible to predict, but we can prepare for them by building a resilient portfolio, a portfolio that can weather those storms and come out stronger on the other side.
Okay, I like that. A resilient portfolio.
Mm.
But how do we actually build that resilience? What are the building blocks?
Well, diversification is a big part of it, as we've discussed. Having a mix of investments across different asset classes and sectors can help buffer against those unexpected shocks. Another key element is having a long-term investment horizon.
Right. If we're not planning to sell our investments for 10, 20, even 30 years, those short-term market fluctuations become less important. We can ride out those waves knowing that over the long term, the market tends to trend upwards.
You've got it. Long-term thinking is essential in investing. It allows you to weather those inevitable storms and benefit from the power of compounding over time. It's like planting a tree. You need to give it time to grow and mature before you can enjoy the fruits of your labor.
That's a great analogy. It's so true. But what about those times when we need to access our money? Like what if we have an unexpected expense or decide to retire early? Do we have to uproot that tree?
That's where having a well-defined financial plan comes in. It's important to have a strategy for managing your investments and accessing your money when you need it without jeopardizing your long-term goals.
So create a plan that balances our short-term needs with our long-term goals. It's like having a roadmap for our financial journey.
Exactly. And that roadmap should include not only your investment strategy, but also things like your budget, your savings goals, your debt management plan, even your estate planning. It's all interconnected.
You know, listening to all this really drives home the point that dividend investing isn't just about picking stocks and hoping for the best. It's about building a comprehensive financial plan that aligns with our overall goals and values.
You hit the nail on the head. It's about taking control of your financial future and creating a life of freedom and abundance.
Okay, I'm feeling inspired,
Mm.
but I'm also wondering, how do we stay on track with all of this? The financial world is constantly changing. New information is coming out all the time. Sometimes it can feel overwhelming.
You're right. Staying informed and educated is so important. Make it a habit to read financial news, listen to podcasts like this one, of course, and even attend webinars or conferences to keep your knowledge up to date. And don't be afraid to ask for help. There are financial advisors, mentors, online communities, so many resources that can provide guidance and support along the way.
So we stay curious, we keep learning, and we connect with others who are on a similar path. It's like we're all in this together.
Exactly. Building wealth and achieving financial freedom is a journey, not a destination. And it's a journey that's much more enjoyable when you have a supportive community around you.
You know, listening to all this, I'm thinking back to something you mentioned earlier, those dividend aristocrats and their incredible track record of consistent dividend growth. Are there other interesting stories or lesser-known companies out there that might surprise people?
Oh, absolutely. There are so many fascinating companies out there that fly under the radar. One that comes to mind is a company called Lancaster Colony.
Lancaster Colony. Never heard of them. What do they do?
They're a specialty foods company. They make a wide range of products from salad dressings and dips to frozen breads and even candles.
Wait, candles.
Yep, they're actually a leading candle manufacturer in the United States. But what's really impressive is that Lancaster Colony has increased its dividend for 59 consecutive years.
59 years. That's even longer than Clorox. They must be doing something right.
They are. They're a great example of a company that has consistently delivered value to its shareholders over the long term, even though they might not be a household name. And there are many other hidden gems like Lancaster Colony out there, just waiting to be discovered.
That's what makes dividend investing so exciting. It's like a treasure hunt. Searching for those companies with strong fundamentals, a commitment to shareholder value, and a bright future ahead of them.
I love that analogy. It's so true. The more you learn, the better equipped you'll be to find those hidden treasures.
I'm starting to feel like a dividend detective. But, we've talked a lot about the numbers, the metrics, the strategies. But at the end of the day, what does this all mean for us as individuals? Why does dividend investing matter?
That's a great question, and one that I think everyone should ask themselves. For me, dividend investing is about more than just generating income. It's about creating a sense of financial security, building a legacy for my family, and having the freedom to pursue my passions.
I love that. It's about aligning your investments with your values and creating a life that you truly love.
Exactly. It's about taking control of your financial future and designing a life that is both fulfilling and abundant.
It's amazing how much ground we've covered in this deep dive.
hmm
We've really gone from dividend newbies to, well, maybe not experts, but definitely more informed investors.
I think it's safe to say we've leveled up our dividend game.
Definitely. We've explored those reliable dividend aristocrats like Clorox and even unearthed some hidden gems like Lancaster Colony.
And we've learned about those crucial metrics like payout ratio and dividend growth rate, which can really help us evaluate companies.
Plus, we tackled some of those big picture questions like how interest rates and those unpredictable black swan events can impact our portfolio.
Yeah, we really went there.
But, for me, one of the biggest takeaways is that dividend investing is about so much more than just picking stocks and hoping for the best. It's about aligning our investments with our values and creating a life of purpose.
I completely agree. It's about taking control of our financial future and designing a life that we're passionate about, a life that is both fulfilling and abundant.
Okay, I'm feeling inspired. But I also know that taking that first step can be daunting. What advice would you give to someone who's just starting out on their dividend investing journey?
Don't be afraid to start small. You don't need a ton of money to get started. Just begin with a small amount that you're comfortable with and focus on learning the ropes.
So start small, be consistent, and never stop learning.
Exactly. And remember, this is a marathon, not a sprint. Enjoy the process.
I love that. Enjoy the process. It's so easy to get caught up in the numbers and forget that this is all about creating a better future for ourselves.
It's important to keep the big picture in mind. Why are you investing? What are your goals? What kind of life do you want to create? Let those questions guide your decisions and keep you motivated.
It's like we've been handed a treasure map, but the real adventure begins when we start exploring and digging for those hidden gems.
I like that. And remember, you don't have to go it alone. There are so many resources available, financial advisors, online communities, even podcasts like this one.
So as we wrap up this deep dive into dividend investing, we want to leave you with one final thought to ponder. What does financial freedom mean to you?
Is it early retirement, traveling the world, pursuing a passion, or maybe it's just having that peace of mind knowing that your finances are taken care of?
Whatever your vision is, dividend investing can be a powerful tool to help you achieve it. Remember, it's a marathon, not a sprint. Stay focused, stay informed, and most importantly, stay excited about the journey. Happy investing, everyone.